On today's episode of the AI Investor Podcast from 24/7 Wall Street, we're sharing 3 new additions to the AI portfolio and diving into the earnings of one of the market's most important stocks. All of that and more is next. Welcome back to the show. I am David Hanson, joined by Eric Bleeker. Eric, I wanted to give a quick shout out to some newer listeners. Our audience is growing. It's not huge, but we love to see it growing. We did that podcast last week. We said, share this with any friends. I think some listeners did share it. We've seen some more people jump on, subscribe to the podcast. So big shout out to all the new people who are joining the show for the first or second time. Happy to have you. And of course, shout out to the original listeners who have been with us from day one. Not many of them, but appreciate them as well. The goal of the show is to share our top ideas with as many people as possible in the AI space. So excited to have more people on board. And that's what we're going to try to do today. I think we have a really, really great show, a lot of interesting stuff to hit on. And of course, like I said, 3 new stocks to the portfolio. So let's start off with just looking again, as we sometimes do, at the market at large, taking a little bit of a 30,000 foot view. There's some craziness going on this week. I wanted to start with your thoughts on, it's been a great week. The market is going back and forth. We had, inflation dropped a little bit and we see stocks take off. So how are you kind of thinking about this interest rate dynamic that seems to seesaw every week one way or another, and it's really driving kind of the overall movement of the market right now?
Yeah, I kind of highlighted 3 different stories I thought were really interesting that kind of captured what's going on this week. As you noted, interest rates are really driving the market right now. Since Wednesday, we've had a pretty intense rally, right? It's kind of moved stocks from being down a fair bit this year, halfway to correction territory, to green for the year. And I wanted to dive a little bit deeper into what exactly is going on. So on Wednesday, the market was up most dramatically. The NASDAQ was up 2.45%. The reason for that was headline inflation numbers. CPI came out, and core CPI, which was expected to hit 3.3%. The headline figure across every single news release was 3.2%. With inflation coming in below expectations, you're almost looking for 2 things right now for the market to move. You're looking for weaker jobs data or inflation coming in light, because both those things are going to lead to, better interest rate environment for stocks. Now, here's the details I find really interesting, David. This shows how on knife's edge any near-term performance is. The actual number for core CPI was 3.248. Meaning if it was 0.003% higher, the headline would have been 3.3%. We will have merely met expectations. Hey, the market might have still risen that day. But again, when you're getting too obsessed with short-term performance in stocks, you always got to keep in mind, these are the margins that you're dealing with. That on today's show, we're coming into it. I looked at it before we talked the portfolio. It's up 16%, 17 out of 19 positions are in the green. Hey, if we would have had inflation 0.003% higher, well, maybe we would be talking today with the portfolio up 8% and half of the positions in the green. So, I thought this was a really good example of how fine the margins are in the short term, for people watching the market.
Yeah, I mean, it's interesting to see those, 1 or 2 percentage point moves of the overall market. But I think to bring it back to this show, where we see the really big moves and what we're focused on is those business results, and these companies hit an inflection point. Again, we think back just a couple weeks ago, Credo jumped 50% in a day because of business results. It wasn't because, the 10-year moved down a little bit. So I think, we're going to comment on the interest rate environment. It's hard not to when it's the headline, but ultimately, again, the point of this show is we're looking at the stocks in the portfolio. What are their business results? Are they hitting kind of those inflection points that we're hoping to see? So that's really what's ultimately going to drive Credo or Coherent or any of these companies to be a winner. It's not necessarily, the 10 years down to 4%. Therefore, it's a buy, or it's at 5%, it's a sell. So we'll watch it. But again, much bigger things, I think, impacting our portfolio in the long run. The second story that you sent over to me this morning was the headline, "Is a real life Jurassic Park here?" I didn't know what the story was. I immediately just I thought of the line in the movie. It's like, just because you can doesn't mean you should. So what is going on, and why did this catch your eye? What is this story?
Yeah, you would figure you'd watch Jurassic Park and the takeaway won't be, oh, we should go make this. But right. That might be what we're seeing in real life. Colossal Biosciences. They just raised another $200 million, gets them to $435 million in total. It's at a $10 billion valuation. Their goal, They want to resurrect the woolly mammoth by 2028, the dodo, the Tasmanian tiger. I don't know what the business model for this is, David. I don't have any idea. I'm sure there's some downstream, implications. I just thought this was an interesting story. The other thing that you'd have looking at this, I think, as we're starting to see some huge advances in specifically the healthcare industry in the next decade from AI, expect to see more stories like this because, again, we've talked about things are about to start getting kind of weird. Well, I don't know what's weirder than a company raising money at $10 billion to make a real life Jurassic Park.
Well, I just looked up. It looks like Beyond Meat, the company that makes artificial meat, is down 96% since going public, or 93%. So fake meat has not necessarily been a winning strategy in the market. Maybe we can bring back that woolly mammoth meat and
mammoth meat.
Kind of our mammoth meat. Reserve the ticker now. It might be coming. All right. So last kind of news story that I wanted to hit on that you sent over is, is the end game of artificial intelligence in sight? We talked about some of the models that have been released in the last couple of weeks of really raising some eyebrows, particularly of the online community who's working on this day to day, of people being like, I don't know if people understand what is happening here and what is developing. So what has happened over the last week or so that's continued to get your attention in this space?
Yeah, and I spend a lot of time watching kind of deeper into the AI community. I want to pull out the takeaways from that because, it is very in depth, but there is one person that's very widely followed, maybe the most widely followed in artificial intelligence. Someone, they just go by the name Gwern. I don't think their real identity is known, but they've published for years. They've been very forward looking. They've been very accurate. And what they said this week in a post was, I'm going to just kind of reiterate here, that there may be a sense that artificial intelligence has broken out and has finally crossed the last threshold of criticality from merely cutting-edge AI work, which everyone else will replicate in a few years, to take off, cracked intelligence to the point of recursively self-improvement, and where the next OpenAI models, O4 and O5, are able to automate AI R&D and finish the rest. David, that's kind of a mouthful, but what this person is effectively saying is that we've talked about these reasoning models, how they go through this kind of thought process, and that creates training data to create better future iterations of models. And this technique is proving astoundingly capable. This person who's called prior advances in artificial intelligence the trajectory, they're starting to say that they believe that this might be an end game where AI is good enough to essentially kind of automate itself in the very near term. I don't know how else to say it. I said this in last week's podcast, the podcast before. Since this newest OpenAI O3 announcement, I've seen almost euphoria from researchers in the space. It's definitely a tone shift people should not be ignoring. And you look at some of the real world kind of examples this week, David, Goldman Sachs, they came out yesterday saying that 95% work in S1s is now done by AI. Harvard MBAs are having 10 times as hard of a time getting a job right now. I think their unemployment rate 90 days after went from like 2 to 25%. Salesforce said they're not going to hire any more software engineers this year because productivity's jumped so much from a lot of the tools. And David, I thought this just kind of does highlight, what we're talking about with the show, that this is possibly the biggest breakthrough in human history, but there's going to be a lot of ways that this is difficult to digest in society. And one of the biggest ways, anyone watching, number one, it's interesting to watch, but it's not going to be perfect, right? It's like you watch the nightly news. You're not watching that to say world peace achieved. It's messy in the near term. And the best thing you can do to protect yourself, your family's future, is to align your capital with a lot of these areas that are moving at a pace far higher than the market, than, the expectations for the growth we believe is still not baked in. So being able to, profit from this and align your personal capital with this opportunity, it might set yourself up for a time that otherwise would be, something that can be a little uncomfortable, right?
Yeah. And again, we've talked about the advancements, and so much of the investment in our portfolio that we have now and over the past year has been talking about the infrastructure of AI. Again, not necessarily consumer facing applications, but, not that Goldman Sachs is necessarily a consumer facing application, but, that is a frontline. That's a traditional client kind of type of relationship. They are starting to use the technology. I think Klarna, the company, that I think a year ago they came out and said, we're using a lot more AI in our customer service. I think their CEO last month came out and said, we're actually not going to hire at all anymore. Like, we've just stopped hiring and we're just going to optimize with AI and use the existing resources. I saw yesterday the firm Harvey, an AI company that specializes in legal work, again, a job that, in my opinion, very well suited to be optimized for AI. You know, you're looking up a bunch of old court cases and trying to find context. Raised what I think $300 million at a $3 billion valuation. And that wasn't just on the idea of using AI in legal work. There was reports of them having, you know, annual recurring revenue over $50 million. So real customer, you know, use cases of AI. And as the models continue to get better, again, I really think that this year we're going to start to hear a lot more of these companies, and the speed at which they can go from very little revenue to 50 million, I think might really surprise us, just based on, you know, if companies can save money, there's always going to be the incentive to go out there and adopt the new technology to do so. So I'm with you. A lot to be excited about, but also be a little bit nervous about, because it is a new frontier that we are walking into, and hopefully we can keep ourselves and this audience kind of abreast on what's happening and align your portfolio, as you said. So that's kind of the news. I want to move on to another news item, but then to kind of flow into our portfolio here. We had earnings from Taiwan Semi. It's a company that's in the portfolio, one of the, I think, most important stocks in the market, one of the largest stocks in the market. I wanted to hear your takeaways from Taiwan Semi. It was a positive earnings report. Did you, in terms of the market and the stock traded up, did you have the same takeaway from their earnings?
Yeah, headline definitely very, very positive, because Taiwan Semiconductor is now one of the largest bellwether stocks in the market. You know, if we used to look at how GE would report for signs of broader industry focuses, now Taiwan Semiconductor, what they're saying is going to give you amongst the best insights into the trajectory of AI. Should be noted too, we have 3 stocks we've invested $25,000 in. That's NVIDIA, Marvell, Taiwan Semiconductor. We have 1 stock we've invested $35,000 in, Broadcom. That's about 50% of the portfolio, all really targeting opportunity around what you call AI accelerators, the processors for AI. That outsized bet has been very good for us, because when you're building out AI from soup to nuts, when you're starting from the, okay, we want to do AI, to the last expense items, the first expense item is buying the processors, starting to get those orders in. The last expense items are a lot of the things like, we need to build a nuclear power plant that's going to take a decade, right? So one of the areas is, if AI is on the right trajectory, you're going to see generally good performance. So let's look at Taiwan Semiconductor. Headline that you'd read about in an earnings report: beat on revenues, beat on earnings, guided to a significant degree ahead of Wall Street next quarter. That's always going to get a good reaction. Now, when you dig into the details, another layer, they said that AI accelerators, that market that I said we've been targeting, tripled in 2024. They expect another double in 2025. David, when you triple and then double, that's effectively what NVIDIA stock did. Numbers just get very big, very fast. And up to recently, the expectation was more for 50% growth. They're saying 100% growth. They're also forecasting a mid-40s compounded annual growth rate for AI accelerators off the already very high base that they had in 2024 throughout the coming, I believe it's through 2028 or 2029. And Taiwan Semi, they said that these AI accelerators are now their number 1 growth market. So that's all very bullish. The company itself, they said they're going to grow at 20% rate for the next 5 years. I did the very simple math here. That gets them to around $220 billion in sales. Wall Street at the end of that period has them at $180 billion. It shows AI is going to drive that significant upside that's still above market expectations. And the last thing we have that's worth noting, their capital expenditures for this year, they forecast them at a midpoint of $40 billion, should probably come in over that. Wall Street's expectations was $36 billion. Last week, we kind of broke the seal on semiconductor equipment with Lam Research. We're going to break the seal a little bit more, but this week you see the environment's getting better there. So David, you know, the bottom line with Taiwan Semiconductor, I talked about them being a bellwether. This is a very conservative company that's been through every single cycle. If they're taking all these growth rates up, if they're taking them up not just in 2025, which they have, but the next 5 years, it's because they're talking to the people holding the purse strings. They're talking to Microsoft. They're talking to Amazon. They're talking to these hyperscalers. And that's where these companies' plans are. And as we noted, developments in AI in the past month or two are probably even accelerating these plans. So I look at this, I was surprised the reaction wasn't higher yesterday because what they said is about as bullish as you can get. I was very astounded by it, and it continues to cement my belief that the strategy the markets we're looking at are on the right track for what the markets go wake up to as this year goes.
Yeah, we've talked about a big risk for the entire AI space of what could cause a big pullback is, some whisper of slowdown in spending starts to creep in, and we're looking for that first sign of it in kind of companies like Taiwan Semi. And to your point, it seems like we kind of got the opposite of a slowdown. So no signs yet, although we will keep our eyes out. When we first brought Taiwan Semi into the portfolio, one of the questions I asked you was, it's impossible to talk about Taiwan without talking about China and the potential risk there. At the time, you said, it's a well-known risk. It's baked into the valuation. We feel comfortable, and it's proven out in the short run that, the stock has moved higher since we bought it. This week, we also got more news involving AI and China. President Biden, as he's walking out the door, dropped some new regulations. So let's just move into that story a little bit. If it impacts Taiwan Semi, we can touch on that. But more broadly, what are these new regulations, and is that a new risk that has now entered the table? We've always talked about where does China sit and how big of a risk is that? We've talked its impact on a company like Lam Research. Did that risk just get turned up, or is this kind of the same as what we've been operating on?
Yeah, it's a great question. Background, export controls. First one was in October 2022. We got more a year later in October 2023. Last July, these export controls were further refined, and that led to a massive sell-off across the semiconductor space. So despite the rise of AI, semiconductor stocks, they dropped 25% in a month. And that's from the SOX index, which you can track it. Since July 10th, they're down 15% as a group. The market's up 5% that time. So that's 20% underperformance. So that kind of sets the table for everyone of how big a reaction this could be. So what are these new rules? Well, essentially, we've set controls for countries specifically. Let's call it what it is. It's targeting China, right? And China's still getting chips. There's still loopholes where they're able to get chips. So these newest regulations kind of aim to close those loopholes. And what you have, it's kind of like defense contractors. If you're a Lockheed Martin, you've got approved companies that you can sell your F-35 to. You've got companies that, you're going to need extra layers of approval, and then you've got companies you can't sell to. Similar to that, we've got tier one countries that there's about 18 of them, and they get unrestricted access to AI chips. You've got tier two countries. That's almost every country in the world. It's, 80 to 90% of countries. And they're going to have quotas, and there's going to be an agency that is going to essentially approve these sales. And then you've got tier three countries, which is China, Russia. They have the highest restrictions possible. So what are the implications of this? Well, I think we do have some clear winners and losers. On the winners end, you'd have the hyperscalers that we've talked about, Microsoft, Amazon, Google, because one of their biggest competitive dynamics is you have these smaller cloud companies focused on AI. We call them neo clouds. It's going to be a lot harder for them to operate. Another probable loser that almost fits in the hyperscaler category of size is Oracle. They were making massive investments in companies like Malaysia that are now on that tier two list. So they might not be able to keep up with their rivals. Another loser is going to be NVIDIA. NVIDIA, I talked about in the last podcast, they're really executing well, and they're setting up for a good back half of 2025. I could see the front half being a little more shaky. They were down about 15% at the peak, and I was kind of starting to go, is this just interest rates? Well, I think news was kind of leaking of, the size of these restrictions. And these restrictions are really going to remove loopholes that chips that previously would have gone to a country like Singapore and ended up in China. That's going to essentially be kind of removed by these frameworks. Now, the companies themselves, they're obviously not happy. And, you need to balance between two areas. Of course, a company that's seeing sales go down is not happy with it versus, what might be best for the country. Mm-hmm. I would say the greatest critique of regulations like this as you noted, it was kind of dropped on the way out the door. Companies had close to no input, as they were complaining about. They get 200 pages of regulation. And I think there's going to be some refinement from the Trump administration coming in. Things like government agency needing to have very strict oversight of some of these controls. They might not move fast enough, especially when NVIDIA is moving to 6-month release cycles. Your approval might take longer than the release cycle. So I could see Trump refining that. In terms of really big takeaways, I still don't think we've seen what the Trump administration strategy is going to be. They might lean more into these existing regulations, or they might use them as a bargaining chip to get concessions elsewhere. So that's going to be when we find out what the Trump administration's true intentions are, that's when we're going to see the biggest reaction to this. But in the meantime, I don't think this changes the trajectory for most companies. The companies I mentioned, like Oracle, NVIDIA, are probably the biggest near-term losers. But for most the stocks in our portfolio, I don't think this presents a big shift. Maybe could take away a couple % of growth in the year ahead, but they'll probably surpass that with other opportunities.
Yeah, I mean, I think I'm not envious of the position of anyone in Washington trying to figure out what's the perfect thing to do. It's when you have a technology that's changing so quickly, companies that are growing so quickly, it's a very hard thing to do. And to think that we're going to nail it and get it exactly right is wishful thinking. It's going to be a process. Hopefully we just don't make any large errors, but I think it's impossible for us to sit here and say, here's exactly what we should do to, keep the country safe and keep American companies thriving. It's a tricky balance, but one, again, we will continue to watch and talk about on the show. I want to move into our next segment. We're going to talk a little bit more about a theme that we've touched on in prior episodes, and that's going to lead into the 3 companies that we're adding. And that theme is high bandwidth memory. We don't want to go too down the road of nerding out and getting too technical, but let's talk about what this is a little more specifically in the world of AI, why it's important, and then bring back in the companies that we're going to be adding to the portfolio and how they fit into that trend.
Yeah, I had someone shoot me a text this week saying, "Hey, high bandwidth memory, is this stat correct? That's going from a $4 billion to $130 billion market?" I said, "Yeah, maybe that's what I should just lead with in our next show." So that's what it is. A market growing by 26-fold or whatever the number is. So if your ears are, if you find yourself zoning out any part as I'm talking about memory, just remember, we're bringing this back to a 26x growth market. So the other opportunity that's really worth understanding is forecasts for this market are accelerating at extreme rate. I was watching a video on it the other day using mid-2023 market forecasts, talking about the market getting to 6.3 billion by 2028. Well, this year, the newest expectation from Goldman Sachs is 36 billion in 2025. Yet, the number one company at the center of this trend trades for less than 6 times this year's earnings. So, for anyone listening, when you have a market that's shooting up past consensus at an extremely rapid rate, when you maybe don't have that price in the stocks, it's going to equal an opportunity to make money. So let's talk about memory quickly. Most people, they don't think a lot about, David, computer memory. You might know Intel inside with your computer, but if you've got RAM, you're saying, well, I've got 32 gigabytes. It's just one single number. There's not the enthusiast market or recognition you have with NVIDIA chips or Intel, because memory is a commodity. Because it's a commodity, people kind of discount how large this market is. It's nearly 30% of all semiconductor revenue, yet the value of these companies is maybe a few percent of what semiconductor companies are worth. And again, that's because there has historically been little differentiation, and it's a brutal market in terms of price competition. Now, what's changing? Today, 3 companies, Micron, Samsung, SK Hynix, have 95% market share between them. They essentially control the entire market. Now, headed into the age of AI, the challenge with memory is there's no Moore's law. When we're talking about chips, at its simplest point, it's just make the transistor smaller, right? You're kind of optimizing to one thing. Memory has a few different things you need to balance towards. You need to balance towards capacity. You need to balance towards bandwidth, you need to balance towards latency. What happened was the only thing that most applications cared about was capacity. So we improved capacity in the last 20 years, 128-fold, but bandwidth, we only increased 20-fold, which is 6 times less. And latency, we improved 30%. we essentially stopped improving it. So what happens is, because memory has been kind of optimized towards a lot of consumer applications, and now we need new applications with AI, you're hitting something called the memory wall, where memory isn't good enough for running these kind of large AI models. What are some problems with memory as far as AI? Well, it wastes a ton of energy. I saw a stat from a YouTube channel named Asianometry, which is great. And if anyone's interested, could subscribe to that. It said 80% of Broadcom's chips, which is the one designed for Google, the power waste is the connections and moving data around between chips rather than the actual computing of the models. The other thing is memory itself. It would end up consuming a majority of power just through memory if we didn't come up with a new solution. Now, the other thing is too, memory, because I talked about that slowness and bandwidth that hasn't kept up with capacity, because that bandwidth is lower, you waste processor cycles because they're waiting for data to come in and out. So it's a bottleneck is what it is. And the solution has to be found because there's just too much money at stake. And the solution is high bandwidth memory. And what high bandwidth memory does is it stacks memory directly on top the actual processor, and then you actually drill these infinitesimally small connections that have the memory connect directly to the processor. Now, David, as you can imagine, that adds complexity. But when you're a commodity market, you've been begging for complexity, right? That gives you a way to actually start getting margins. So let's just quickly summarize kind of everything here. Memory, it's a huge market. It's bigger than anyone realizes, 30% of all chips. It was developed in a way that was very inefficient for AI. And high bandwidth memory, it's a complicated packaging, but it solves this bottleneck that we've broken down. Now that we've established what this market is that we're looking at, I want to talk about why people are going to make money from this in our estimation. As we noted earlier, forecasts have gone from 6 billion in 2028. The forecasts for this year were previously 29 billion from Goldman Sachs. They just got revised up to 36 billion. I think it's going to continue even going higher. Now, what's the reason that these forecasts are shooting up? Well, it's these new models. And there's a phrase in AI called context windows. And it's basically the amount of text or tokens that an AI can remember at any given time. And the larger the context window, the more memory you're having to utilize. So the more non-technical point we could bring up is when you're actually running these models, what we call inferencing, and we've talked about, memory now becomes as important, if not more important, than the chips from NVIDIA and these AI accelerators. And now we need to remember from these recent episodes, David, that the breakthrough that we've seen is running more inferencing to make models better. So again, I can stop here, but what we've established is the size of the market. Recent model changes are moving things to inferencing. And within inferencing, memory is significantly more important. So as we continue putting more and more investment in these models that are new, which right now there may be a small fraction of spend, we're going to see the memory market skyrocket. So David, I want to give you a moment to pause and, double click on any of these areas, or else, we can start getting to some of the stocks we're going to recommend today.
Yeah, I want to get into stocks in just a second. And you talk about it being a commodity, trading at a low, price to earnings multiple. So when you think about investing in this space, are you taking a basket approach to saying, I'm not sure exactly who's going to differentiate, so I'm going to, put a couple bets because I might be wrong? Is that the way to think about it? Or how are you kind of narrowing down the universe to be like, okay, these are the ones I actually want to invest in? Because what if you pick the wrong one and it doesn't differentiate and it loses market share and becomes, an even worse commodity that just gets left in the dust? How are you thinking about picking these companies?
Yeah, that's a good question. I've had about 10 companies that I've zeroed my research in on. I think it's kind of a multi-tiered strategy that, it's interesting. We're talking about this high bandwidth market that's forming. The exposure from some of the memory companies like SK Hynix and Micron as a percentage of their business might be lower than some of the suppliers, these equipment companies that specialize in building equipment specifically for this advanced packaging where you can stack the memory chips
right
on top of the logic.
More of a pure play.
Exactly. So you can actually find better pure plays than the memory companies themselves. So we're definitely going to take a basket approach to this. I'm going to recommend 3 different companies today. $40,000 of investment out of $500,000 total. Could I see us going up to 100K in memory this year? 20% plus the portfolio? I definitely could. But I just want to get a starting point. And from there, I could see maybe 6 or 7 different companies from kind of this memory opportunity being within the portfolio itself.
Okay, let's jump into what's the first company that you want to talk about here?
Yeah, so the first company, Camtech,
which we talked about last episode.
Anyone who listened to our bonus episode last week is going to hear some repeating. I will say just a little helpful area for anyone listening today that if you prefer reading, if you go out and search 3 AI stocks that could double, or you search 24/7 Wall Street, go down. We've got a section for our $500,000 AI portfolio. You're going to see a write-up on the memory market, Camtech, other stocks that we're going to discuss today. You can also go to an article we've created called How to Follow Our $500,000 AI Portfolio as a spreadsheet to track our performance. It has frequently asked questions. So if you're listening to this podcast, if you're relatively new and it feels like kind of drinking out of a water hose, hearing about all these companies, we're trying to create resources to be able to catch up and follow along through, what we think is a really exciting time. So
yeah, we'll put that link in the podcast description too. So if you want to just tap the, if you're listening on your phone, tap it and you'll see the link right there.
Yeah. And so Camtech, we've talked about semiconductor equipment. I broke it down 2 episodes ago now, but basically you've got large companies across all the different verticals, and you normally have 2 or 3 main competitors. It's a really good competitive position. It's why these companies are worth a lot and generally have great profit margins. So when you're inspecting chips to see essentially if there's defects in them, it's a space called metrology. The number 1 stock is KLA. They're worth about $100 billion. But whenever you have these big technology shifts within semiconductors, it gives an opportunity for new entrants that are specializing to be able to come in, steal a lot of market share in that area, and effectively compete against these 800-pound gorillas. So Camtech has specialized in this advanced packaging that we're talking about needing for being able to stack memory on top chips. And frankly, where most of semiconductors are going in general. So as we know in our last podcast, they're a tremendously successful company. They're up 50-fold from the bomb in 2016. But the wind's at their back. I believe that they're going to be able to see some impressive growth, especially in the back half of the year as we're going to take capacity up in this HBM market. They were trading as high over $140 a share recently. They came down export controls, so that's a threat. But you're getting a cheaper price. David, I was kind of upset because on I think it was Tuesday, I was trading for $80 a share. I looked today, it was up around 100. That's a shame. But I still think a great opportunity. We love its potential in the year ahead. So stock number 1 is Camtech. It's worth about a little less than $5 billion. Its ticker is CAMT.
All right, let's move on to number 2.
Stock number 2 is SK Hynix. Right now, they are the leader in high bandwidth memory. They're NVIDIA's largest cost center. They've got a great relationship with NVIDIA. Samsung's been racing to catch up with them. They claim they'll do it next generation. They said they won prior generations, were unable to. The headline figure is...
What else are you going to say, though? We give up. We'll never catch it.
So the headline figure is they're worth a little less than $100 billion. Their profits for this year are expected to be $18 billion. That's 5.5 times earnings. Now, most people would say that's insane. Well, some of the background is, again, memory traditionally is extremely cyclical. So if you're a leading memory company and you're trading at 7 times earnings at a peak, that's generally not crazy because it's at a peak and it's going to come back. Then you throw in that they only trade in Korea, which gives them a discount of maybe 20 or 30%. You arrive at 5.5 times earnings. So there's some logic behind the market. But my bet is 18 billion this year, 2025. It won't be the peak because I believe that we're going to see a memory super cycle unlike anything we've seen before, especially thanks to the growth of HBM. So I think this company is going to be cheap. I think if they did do an ADR and they made it easier to list in the United States, they could have an incredible catalyst. I don't know if that'll happen. But the biggest downside right now, you're going to have to likely get an interactive broker's account if you want to buy the stock. It's more complicated. And that's what was holding me off from buying them. But David, I will reveal our third stock right now. And that's Micron, which is ticker MU. And Micron is distant third in memory market share, 20% in the worst of times, 25% better times, bounce around there. They're going to aim for the same amount of market share in HBM. Now, they're worth more than SK Hynix, despite being a good bit smaller. SK Hynix is looking at 18 billion profits this year. Micron is 7 billion according to Wall Street estimates. Maybe they top it if, dynamics in the industry break right. But I could see them, at 10 to 15 billion in 2026 if this cycle continues as I think it might. So is it more expensive than SK Hynix? Yes. Would I rather own SK Hynix? Yes. But if you go into Robinhood, if you go into Schwab, you can type in ticker symbol MU, you can hit buy, and it's extremely simple. So I want to add this as another option to give investors exposure to the memory market because, again, Micron's going to trade at a premium because it's so much more accessible. So, David, there it is. $40,000 total, 10,000 Micron, 10,000 Camtek, 20,000 SK Hynix. We'll start our memory play out. And you had asked earlier, are we going to keep looking at other companies? Yeah, some other peer plays or companies with high exposure. Onto, Form Factor, I mentioned those last week. Another international company I currently own already, but I think has great exposure to these trends. BE Semiconductor, ASM. So there's a lot more companies we may continue adding, and it might be a situation too if interest rates cause that short-term rip down. This will be one of the first markets we'll go to because I think it's going to stay red hot regardless of where the interest rate situation is.
All right, sounds great. Those are our 3 additions to the portfolio. I think that takes us to 18 companies in the portfolio. Again, click the link in the podcast description or go to 247wallstreet.com. You'll see it right there on the main page. You can see the full portfolio. I wanted to wrap up with a couple questions. We do have a mailbag. You can email questions at 247wallstreet.com, or we have our YouTube channel where we'll post some videos of this podcast and some other videos that we'll clip together. You can post questions there. I think one of our questions today is coming from a YouTube comment. So we're happy to take questions to the email address or on the YouTube channel. So I wanted to start first, take a question. This was a question we actually got on the website from Jeff. He says, is there an ETF that you would recommend of the AI stocks that you like? You just talked about, the ease of investing on something like Micron and being able to just type in a ticker symbol. We don't have any ETFs. We haven't talked about ETFs on this show at all. What is your take? And is that a reasonable way to invest in AI? If someone's like, I don't want to go buy all the individual tickers, is there anything out there that you've seen that is a reasonable alternative? Or are there reasons why you opt not to use an ETF to get exposure to this?
Yeah, the reality is there's no one size fits all to investing, right? And it's whatever anyone feels comfortable with. If you're going out and buying an ETF and you're prepared to sit on that for the long term, you're doing better than 95% of people out there. That's a great start because, most people when managing their money, they're not getting the full benefits of market returns over time. Now, the downside of ETFs, especially for trends like this, is you're often not getting the exposure that you'd like. ETFs, they're often in companies that get too stuck. So let's use an example. If you were to look at ARK Investments, which is very popular, they might have a lot more exposure to kind of the SaaS companies and software, which might not be the particular play that you see. We've talked about wanting to work in a phase strategy where we start with processors, we then get data center plays. We're opportunistically adding where we see advancements in things like memory. As time goes on throughout this year, we're going to continue adding more software plays. So, we have a very different strategy that you're not really able to capture in an ETF, is the honest thing, but it does require a little bit more work. So if, an ETF gets you most of the way there and you'd like to listen to this podcast just to hear about advancements in AI, to listen to the two of us wax philosophical, that's great. And, we're not casting any aspersions at, investing primarily through ETF. So what I did was I just went and I started how your average user would, and I Googled best ETFs. 24/7 Wall Street should have been the top result, but hey, Google, they're not always bubbling up the best. So I looked at one of the articles. I looked at what their suggestions were. So the first ETF I pulled up was Xtrackers ETF, which is XAIX. They had some kind of marketing fluff around investing in companies with the highest patents. That's all it is, right? You're looking for some way to differentiate when you make an ETF. I won't pay any credence to that. Their top holdings were in order: Facebook number 1, Bank of America number 2, Amazon number 3, Salesforce, Apple, Nvidia. They had some interesting stuff in there. They had SK Hynix, which, like I said, can be difficult for most investors to buy. But David, I saw your face squinch up when I put Bank of America number 2, with good reason. That might be a perfectly fine company, but as far as AI exposure, it's completely silly. Would I think that this gives you better exposure to AI than just buying a NASDAQ ETF, which should be the question you ask for any of these? The answer is no. So that one gets right away a down thumbs for me. Yep. The second one I looked at was Roundhill Generative AI and Technology ETF, ticker CHAT, kind of work off Chat GPT, I would assume. 0.75% expense ratio. It's kind of in the zone for an ETF that uses some active management. Honestly, this one was better. Their top 10 holdings were NVIDIA, Google, Microsoft, Meta, Taiwan Semiconductor, SK Hynix again, Hewlett Packard, Dell, Arista Networks, Marvell. I like most of those stocks. I think they're pretty aligned with AI. I would honestly say that was the best of the bunch that I looked at. If I looked at that, I would say most of these stocks actually have good exposure to AI. You're getting what it promises. Mm-hmm. That would be a better candidate. And finally, I looked at Global X Artificial Intelligence and Technology ETF, AIG. I don't know if I would want the ticker AIG if I was building something,
It's got some bad memories from 15 years ago.
Yeah, and this one had Tesla, Broadcom, ServiceNow, Netflix, Cisco, Meta, Salesforce, IBM, Amazon, Oracle. So, again, I can see why the stocks are fitting in, but that's probably not the allocation I would personally want. I would go with the Chat ETF before. So, big picture, just look at the actual holdings. Look if they're actually using a methodology that's getting you towards the stocks that you want. And if they're not doing that, just buy an index that's aligned to the NASDAQ. And that's going to generally give pretty good exposure to the themes. I've said in the past, I would buy, I own a lot of hyperscalers in real life, non-AI portfolio, my personal holdings. Mm-hmm. I mostly just don't put them in this portfolio because I think everyone already owns them and I want to get people tighter exposure to the trends. So I think just owning some allocation towards NASDAQ, if you're excited about artificial intelligence, is perfectly fine.
All right, great. Well, it's been 13 years since I once worked at Bank of America in a previous life, and wasn't necessarily a bastion of technology back then, but hey, maybe it's embracing AI then in a way that they were not when I was there. So let's go to our last question. This one is the one that came from YouTube, from a username Cubs fan. It's been a rough couple of years for Cubs fans, but they had their World Series, so it's okay. This is a long question. I'll shorten it a little bit, but his main question was curious how you guys are thinking about how all these data centers are going to be powered. Also had some questions about cybersecurity and are we going to start using drones, AI drones? So let's focus a little bit on how are these data centers being powered? And if you want to weigh in on, he had some spidey senses on where's quantum computing and Russia-Ukraine war, Israel, Iran. Got a lot going on in this question. So we'll start with the power. And then if you had any other thoughts on kind of the cybersecurity aspect of AI, which we have not really talked too much about on the show yet.
Yeah, power is something, frankly, I wish we had done better on. A lot of attention when we first launched the podcast, which was in end of August into September, was on nuclear. That wasn't a space I was super comfortable with because I see the lead times involved. It's really predicated on where AI is today. We've already seen changes since then where, if these reasoning models really become kind of the next scaling paradigm for AI, we might actually move to more smaller data centers, closely networked together in an area, but smaller and maybe not needing that dedicated nuclear plant. There's other solutions around natural gas and other areas. And what I missed really was you've got a group of companies called the independent power producers, and that would be Vistra, Constellation. This is a business that historically hasn't been great, but when you are at that kind of capacity constraints, it becomes a very good business. And so when I was looking at these companies originally, I pulled up Vistra's income statement, and in the first quarter of last year, they dropped 31%. The second quarter, which I will have been looking at when we first started the podcast, they dropped 31%. They dropped 20% in the fourth quarter last year, 31% in Q1. They finally started growing in Q2 of 21, and then Q3 they grew 54. So they've hit their inflection point. I just didn't really understand, because one of the complications is, AI's added workload to the power grids 8 or 9%. So I go, that's great, but does that mean I want to buy utilities that are often up 40 or 50% at that point? I didn't really see that. And I should have seen the opportunity a little bit more around these independent power producers. I would love to add them to the portfolio. It's just, again, they're very expensive. I think Vistra, what do I got? It's up 342% in the past year.
I believe Vistra was the best performing company in the S&P 500 last year, better than NVIDIA and any of these other companies that we've talked about.
Yeah, and Constellation's up 182. Another company that GE spun off their engine unit, and it does other things, but GE Vernova, GV's the ticker. They're up 200% since they spun up. The more you look in the space, there's a lot of weird things. Yesterday, I found this company because I was looking around ideas in the space. Power Solutions International, it's PSIX, was up 2,000% the past year. Had been trading for basically 1 times its cash flow before that, because it was trade on over the counter instead of trading on the NASDAQ. It got picked up in communities like Reddit, became a meme stock, but it's trading at something like 15 times earnings. It does seem to have some exposure to AI. So, you find a lot of things, and maybe we'll find more, but again, you got to be honest with yourself. And I've been covering 15 years plus of technology. I've never had a lot of reason to go in and understand the economics of utilities. And when you don't have generalism extending to there, you're not always going to pick up the opportunities. And if you have generalism to understand there, you're probably not going to understand semiconductors, right? As far as cybersecurity, again, I personally own CrowdStrike, Palo Alto, SentinelOne. So I have personal exposure. I thought about adding these companies when we first started making some of our agent plays. I still might in the future. We just haven't gotten to that point yet, but I think that's definitely on the watch list. And the final area that you mentioned, drones. I think there's definitely something very interesting with drones. I think companies that are defense contractors and are making the shift towards being autonomous first are very powerful. If Anduril, which is run by Palmer Luckey and has really been at the forefront of a lot of autonomous military activity, if that was public, it would be in the portfolio, no question. Palantir is a company, again, when we wrote up a report close to the start of last year about AI, we include that in our top 3. It's got great military exposure. I just haven't added that because of current valuations and taking advantage of other opportunities first. So, we'll see if we get there. It's just, it seems like some of the best companies, unfortunately, if you were investing in space 10 years ago, right, it was SpaceX was public, you have done fantastic, but
Right.
it just wasn't. And we might have a little bit of that dynamic going on right now with the investable kind of drones universe. But there are companies, AeroVironment, there's Elbit Systems of Israel. So I've sniffed at those. Maybe we'll do some more sniffing in the future because it is definitely an interesting space.
Yeah, and I think it's easy to point to some of these themes that seem very obvious. Like, of course, we're going to have an increased need for cybersecurity. Even if you get the theme right, there's still a lot of variance within the category. Actually, maybe you remember I was at the gym the other day and I saw someone wearing a FireEye shirt, which was an old school cybersecurity stock, which I think I owned it and didn't have the best results with it. So you do have to be picky. You still have to go down to which companies are actually benefiting. You can't just buy the theme and blindly, be like, oh, we think this is going to be big, so let's just throw money at a handful of companies. It doesn't always work out that way. So that's, again, we try to only bring the ideas that you feel really good about, that you have expertise in, and not just saying, oh, it seems like energy would be a good thing to do. So try to be a little bit discerning here.
Well, it's funny. I will note, I had a meeting with NVIDIA in 2015 that really changed what I thought about the trajectory of AI. And the companies I met with in that trip out to Silicon Valley were NVIDIA and FireEye. So, you could not have divided any more. But yeah, and I would say too, with power, we did have an episode. If you go back and look through our old episodes, we did have a episode where we dove into power, kind of how it functions at a high level and where opportunities might arise. I think we focused a little bit more on why nuclear was suddenly kind of in vogue. But what we ended up doing in that episode was we approached it from the company supplying the power equipment, the data centers itself, which was Vertiv and Schneider. So that's how we had approached it originally. Like I said, I wish I would have approached it with the independent power companies, but we have looked at that market and we have issued recommendations.
All right. I think that's all we have for today. I know we went a little bit long. Appreciate everyone sticking with us. We will see you again in 2 weeks. For Eric Bleeker, I'm David Hanson. Have a good week.
People on this show may have interest in the stocks they talk about. This is not investment advice, so don't buy or sell based solely on what you hear.